Viewers, just a few days back, we had a very interesting and engaging conversation with R. Balakrishnan about the mutual funds that are on offer in India. Today, we have someone who's joining us for the first time, and he is an expert on exchange traded funds or ETFs because he was the one who devised the first ETF, the Nifty Bees for India in 2001. Meet Rajan Mehta. Rajan, welcome to PGurus channel.
Thank you. Thank you for having me, Sri.
So, Rajan, I was amazed that ETFs constitute 19% of all assets under management. And if I look at all the comments that came on the Hangout with Bala, many people are saying that, oh, I'm hearing about ETFs for the first time. And I'm like, in the United States, mutual funds are actually going down and ETFs are all the rage for the last few years now. So, Rajan, perhaps we can start from where you started out in life because viewers are, seeing you for the first time. So maybe you can lead us through your life journey, how you started, where you started, and how did you end up, starting the first ETF for India. Please go ahead.
So I was working with DSP Merrill Lynch in India and looking after clients' wealth, and we always looked for good investment avenues. And I was seconded to Merrill Lynch London in 1997, and there I was exposed to international investing for my clients. And ETFs were new elements that time, and then I was very inquisitive about that, and more I learned. I just saw the potential, immense potential the instrument has for various markets and various investors. And so I started using it for my clients, and then I started dialogue with some of my colleagues that we can do the same thing for India because worldwide is just starting and it's going to have a great future. And my colleagues were very enthusiastic, and so we came together and started the benchmark asset management. And with God's grace, we got the licenses, investors, everything together because it must be in destiny to do this. And that's why we came together and started benchmark asset management. And we launched various innovative products, including we conceptualized the first gold ETF in the world. Unfortunately, we were not the first to issue, but officially it's documented that we were the first to kind of move the idea of commodity ETF anywhere in the world.
I see. Now, in a market which I consider shallow, and I'm going to play the devil's advocate here for a minute. Many times when I speak about India's stock market, they say yes, there are 5,000 odd shares listed, but only 150 are active, and then Nifty is 50 of those, and therefore there's not a whole lot of stocks, and yet there are so many, I think 400, equity funds, of which about 70 plus are ETFs. Now, perhaps you can explain to us a little bit about how the ETFs were derived in India, and also a little bit touch upon the difference between a mutual fund, which is actively managed, and an ETF, which is perhaps passively managed. I don't know exactly. Perhaps you can, compare and contrast the two for us.
So ETFs growth happened on philosophical indexing. Indexing became very popular worldwide, and to invest in index, you have got three options. You have got futures, index futures, which are traded everywhere. Then you have got open-ended index fund, which is like John Bogle started with Vanguard, and it became one of the biggest fund in the history of mutual fund. And then you have ETFs. Mm-hmm. So it's better to understand the different aspects between three of them for indexing purpose. Now, active mutual fund is a different ballgame altogether. And if you believe in active management and if you believe in capability of fund manager, then open-ended fund is the best vehicle to go for. But indexing as a philosophy started with many kind of Nobel laureates promoted it. Warren Buffett also write in their annual letter to shareholders that is the best way for people who are not actively involved. And it has shown over history and US especially that most of the active management funds, they underperform the index. So it's for any retail investor, it's better to do indexing. And let me come to the instruments, various instruments of indexing. So futures is purely from speculative purpose because you roll over, and also it's a leverage, and so many times there's a margin requirements are there, so it's not suitable for long-term investors. So long-term investors have only two options. One is open-ended fund and ETFs. Now let's understand the difference between this ETF and open-ended fund. Now in olden days, or maybe sometimes now, there used to be something called close-ended funds. Close-ended funds are ones, they do their IPO or new fund offering as we call it in India, and then you get the money, then you invest and you don't issue any further units, neither you redeem any units. And those funds were listed on exchange. So we used to have a long time back a fund called Morgan Stanley Growth Fund, and there were many other funds were there were of this nature. Now the problem was there that this investor, when they wanted liquidity, they had to go to market to trade
Yes.
that fund.
Yes.
And because there is no kind of arbitrage avenue available, these funds either used to trade at steep discount to NAV or maybe hefty premium to NAV, which is not the true value of that.
Right.
Now, ETF, what they do is, to this kind of exchange traded instrument, they provide a safety valve. Now, safety valve in the sense is it becomes an open-ended fund. So, suppose there is a discount available in the market, there is an entity called authorized participants. They can buy back the funds from the market and redeem at NAV, close to NAV with the mutual fund. Inversely, if there is a premium persisting in market, they can create new units at NAV and sell it in market. So in market, the exchange price of this units track very closely the NAV of the underlying units.
Now, the what is a typical load on an ETF in India today?
The all ETFs are no load by definition.
No load. That means, like, is it like even that's like 0.2% or something like that, or even less than
No.
that?
So there is nothing called load on ETFs.
Okay.
But there is one major difference between ETF and open-ended fund. So when ETF, when I told you there's authorized participants,
Right.
when they create units, they have to pay all the cost of creation of units, which is including purchasing of securities,
Right.
custodial charges, everything. So there is a load on these people, but the fund is not charging anything. They are just paying their cost.
I see.
And they load this cost in terms of bid offer spreads in the market. So fund comes with totally invested form. It's an in-kind exchange, as we call. The fund gives units and they receive the invested stocks in return.
So if you look at the meltdown that happened in the United States market, I'm just going to draw your attention to the United States market. The Dow went from 29,000 to about 19,000, and then now it is back at 23,000, and they're not sure it's going to go there. It might go up and down and up and down. The interesting thing, if you look at, is in the last 4 or 5 years, the run-up in the stock market of United States was primarily due to what is called as FANG stocks, FAANG, Facebook, Apple, Amazon, Netflix, and Google. You take those things away, and the stock market hasn't moved much in like 6-7 years. Now, in India, again, in the Nifty 50, probably, can you perhaps list the significant players today? It doesn't have to be accurate. I'm sure there's something like INFY, Infi is one of those, and I don't know. I'm just thinking that it could be one. Which are the critical shakers and movers in the Indian stock market?
So if you look at Nifty weightage, I think you have right there, HDFC Bank, Reliance, and other technology CS and other technology stocks like that. So they are the movers. But what happens is if you see that its leadership changes over various time period, after maybe 5, 6, 7 years, there may be different leaders are there, different bellwether stocks are there. But the beauty is indexing. The investors, if they are not stock pickers, the index keeps on adjusting to these leaders automatically.
Right.
So that's the beauty of indexing.
Now, see, most people who are working in, say, big corporations, they are investing indirectly in mutual funds through what I say as SIP, or systematic investment plans. Now, I'm not sure how many of those include options to choose like ETFs. For example, when I used to pick something like this in the United States, 401k plans or IRAs or things like that. Typically, you would have like, say, either Vanguard or Schwab or somebody like that, and then they will offer you a set of 10 or 12 funds. And then you go and pick and you do your research and see which ones you're comfortable with. There's a more aggressive growth, there's that, so on and so forth. And then you say, okay, this is what I want my deductions to go into on a periodic manner. Now, in India, do SIPs now have they started offering ETFs also?
So ETFs are bought and sold to stockbrokers, and some of the tech-enabled stockbrokers, they do offer something called stock SIPs,
Mm-hmm.
and ETFs are there on the platform. Like maybe ICICI Direct, or HDFC Securities, various other brokers who tech platform. They do offer ETF SIPs.
I see. Now, viewers, it's very important now what's going to happen post-corona. And this is my guess, and I just this is my opinion, so don't hold me to it. Is that you're going to have significant separation in various segments in the industry. Some are going to have amazing growth, and the others are going to essentially either some might just stall where they are, and some might actually fall away. So I would encourage every viewer to look at the option of putting some money in an ETF if the SIP there, if your SIP offers that. And the reason I'm saying that is the simple reason that ETFs, you said, like, no load, right? Mutual funds typically have a certain amount of load, isn't it? What's the number that typically runs in India today?
No, so all the mutual fund also are having no loads.
Hmm.
So that's not the real kind of differentiation.
So
But
when somebody actively manages, that person's commission or the overhead for that has to be accounted somewhere, right?
yeah, so that is accounted in annual management fees,
Okay.
and the total ratio is called total expense ratio.
Okay.
So in India, we have got two types of fund. One is if you buy through distributor,
Mm-hmm.
and if you buy directly from the fund, it's called direct plan.
Hmm.
And like say, distributor plan can be 2%, direct plan could be 1%. In distributor plan, you get free advice from your advisor,
Mm-hmm.
and the fund pays fees on your behalf to advisor. So if you seek advice of advisor, then you may end up going for distributor plan. And if you are DIY kind of investor, you may end up going directly to the fund house, and you might get like say 1% total expense ratio. Vis-a-vis that, the ETFs in India are available at 5 basis points. So you save per annum this cost, and that adds up. It doesn't. It looks
Oh,
very small
absolutely. Absolutely. It adds
when you
up.
have one
Yeah.
year, but yeah, when you have horizon of 15 to 20 years and compounding effect, I
Yes.
think it's very powerful, and it adds up big time in your kitty that time.
Yes.
And another myth I would like to kind of clarify, which I think very common with investor, is investor have to pay the brokerage when they buy ETF to the stockbrokers, and they
Mm-hmm.
feel that there is a cost which they have to pay extra.
Hmm.
But as I explained to you, what happens is like if you invest in like say index fund only, but you give money to fund house will have to go and buy the stock themselves to
Right.
replicate the index.
Right.
So they will end up paying brokerage, which you
Correct.
don't see. ETF you see and you pay yourself, and that's why it's coming. But actually your cost is same. On the contrary, what happens is in the normal open-ended fund structure, the long-term investor end up subsidizing the trading cost of short-term investor,
Right.
because when fund pays the brokerage, because you are in fund, you become party to that expense. But in ETF, the long-term investors, they don't end up subsidizing short-term traders' cost. So even though like ETFs can be used by short-term traders, but long-term investors are totally kind of uh, quarantined from that. So
Hmm.
they don't end up paying that cost. So that's why it's very beautiful instrument for short-term as well as long-term investors. Short-term investors because you can get intraday prices, and long-term investors because it's very cheap and you don't end up paying trading cost.
Yes, yes, indeed. And I would encourage all the viewers who have investments like SIP plans and so on and so forth to look carefully what is offered to your company. Sometimes your HR would also listen to you if you say, what about this? I read about this. Why don't you think about including them? It's basically some paperwork that they have to do to sign up and so on and so forth. But sometimes HR can go the extra mile if you talk to them. And because I did this thing in one of the companies I worked for, and I had told them that my mutual fund gave me like 2% return on the year, whereas if I had put the same money in an ETF, I would have got like a 22%. That year was a banner year, and that's when their eyes woke up and it said, "Oops, we are sitting on this for too long. We didn't do anything about it." Because remember that these 401k plans, SIPs, these are not the first thing that HR does. It's in HR's basket. They just sign it and go on and so on. So nobody is actually looking at the performance of these funds until somebody comes and tells them, look, there is something here that you need to look at. So thank you very much for sharing all this information, Rajan, and I would love to have you back again on more topics, because we are in for an interesting ride. This is going to be a roller coaster. There's going to be ups and downs, and hopefully, based on the feedback we receive on this one, we will try and take questions and have an interactive session the next time. And viewers, whatever questions you may have, please feel free to send them via comments on this video, and we will have something as a body of work to work with, so that next time we invite Rajan, we can have that as our material, and then keep talking to him. Thank you so much, Rajan.
Thank you. Thank you, Steve. Bye.
Thank you. Bye-bye.
Hi everyone. In the current scenario with the spread of COVID-19, the printed books are on the verge of becoming outdated, and ebooks are becoming the mainstream way of reading. You can now read our ebook, Who Painted My Money White, comfortably on the Kindle app on your phone or a tab. So now, I'm going to show you how to download Kindle on your phone. Firstly, open Play Store or App Store depending upon your phone. We are following Play Store process, though the process is similar for both Android and iOS. In the search bar, type Amazon Kindle. Tap the first result to open the application page and press Install. Once installed, press Open to start the application. Use your credentials to log in. If you were already logged into an Amazon account, then you will directly reach the welcome page for the app. Tap on Start Reading and then tap on Get Started. Now in the search bar, type the book name or the author name and it will show you the relevant results. Tap on the book and then tap on Read for free. iPhone users can buy the book at a discounted price of just Rs 199. You get a 30 days trial for the app on Android. Tap on the button. On the next screen, press Continue to reach the payment page. After entering your payment details, click on Place Your Order. Once the process is complete, it will show a message saying, "We are setting up your membership." Pressing the cross on the top right corner of the screen will take you back to the book results page. Tap on the book and then tap on Read for free. It will open a new page. Here you can follow the author and then tap on Read Now. It will now open the ebook and you can happily enjoy reading it.